Peter, the president of a large corporation, tells his friend, Otto Outsider, that another company is about to make a lucrative offer for the corporation's stock. Otto buys as much stock as he can lay his grubby little hands on, including stock owned by Ingrid Ignorant. Later, when the other company's offer for the stock is announced, the price per share skyrockets. Otto makes a bundle. Peter can certainly expect return favors from Otto, and Ingrid feels cheated, bamboozled, mad. The question for you is, what do we have here? Who, if anyone, is liable? Are the corporation, its officers, or board of directors liable for not announcing a potential merger? In other words, should they have made a special announcement and filed an 8K when they first learned of the other company's possible interest in the corporation? The SEC has held that corporations do not have to disclose merger negotiations if, 1, the corporation didn't make any prior disclosures about those negotiations, 2, no other SEC rules require disclosure, and 3, management determines that disclosure would jeopardize completion of the merger transaction. So there usually is no liability for not having an announcement about a merger that is still uncertain. But as for Peter and Otto, both have violated the insider trading laws. This is the classic example, a simple one, of an insider, Peter, who tips off an outsider, another person, Otto, who's called the tippee. Both have committed Section 10b and Rule 10b-5 securities fraud due to their insider trading. They can both be held civilly and criminally liable. The rest of the examples shown here are from actual cases. Some trades based on inside information are perfectly legal. One can be an innocent profiteer. Football coach Barry Switzer is at a track meet when he inadvertently overhears a Mr. Platt mention to Mrs. Platt an impending corporate sale. Switzer trades on this information and profits from that information. Once they see how the stock price has gone way up, those who sold their shares are, of course, quite sad. But their feelings of loss do not translate into liability or guilt for Switzer. Since Mr. Platt does not mean to tip off Switzer when he's talking to his wife, Mr. Platt is not an illegal tipper, and thus Switzer cannot be an illegal tippee. A tippee is only liable if he knows or should know that he has received secret information that was wrongfully passed on to him. For example, if, say, a noted Florida economics professor likes to go through public dumpsters in search of interesting paraphernalia, and he spots a document marked confidential about a proposed corporate transaction set to take place a week later, he could trade on that information without violating the securities laws. He was not intentionally tipped off. It also would help the professor's defense that he really is taking a risk in that he has no way of knowing that the corporation has really decided to and will in fact carry out the transaction discussed in the document. Maybe the document was trashed because the whole idea was trashed. So that is not illegal insider trading. Other than an intentional communication of inside information, the only other way to hold liable the outsider, that is, the non-insider is the misappropriation theory. When financial newspapers or magazines speak favorably or disparagingly about certain companies, that obviously can affect the trading volume and price for stocks in those companies. Thus, these financial periodicals, such as Businessweek, require that their contents be kept confidential until released to the public. In that last example, an employee of Businessweek's printer met two tippees and sold them advance copies in violation of the printer's own confidentiality rules. Later, one of the tippees passes the advance copies on to another person. Substantial sums are made while trading occurs based on these advanced copies of Businessweek. Now, in this actual case, the U.S. Circuit Court approved and affirmed the insider trading convictions based on misappropriation of private property. It did this because, one, the tipper breached his duty of confidentiality, and two, the tippees knew that the tipper had breached this duty of confidentiality. The government need not show that the tipper or tippee personally benefited or that the tipper knew what the tippee would do with the inside information. The court said it was protecting property rights and information, and clearly the tipper must know that the tippee's interest in the information is not for nothing. I kid you not, this is actually the wording given by the circuit court in this case was what the tippee got was, quote, not for nothing, end quote. So the idea is if you clearly seem to be up to no good, that's good enough for us. They're all guilty, the tippees and the tippers. However, if the chain of tippees gets long and attenuated, the courts likely will find no illegal insider trading at the end of that chain. There was a 1991 case in which the defendant heard about a possible buyout of a grocery chain. The information came to the defendant from a man whose wife was a niece of the president of the grocery chain. The court overturned a conviction because there was no proof that the defendant knew the tip breached a duty to keep information secret. After passing through several channels, when does what might have been considered confidential information become merely market gossip with no expectation of confidentiality? That is an important question when you have a chain of tippees. When one looks at insider trading cases, the factual circumstances and the underlying legal questions revolve around duties, broken duties to keep information confidential. Raymond Dirks, an investment analyst, talks with several former and present employees of Equity Funding of America. Dirks decides that Equity Funding's assets have been vastly exaggerated due to fraudulent corporate practices. Over a 2-week period, as Dirks investigates and spreads the word about Equity Funding, its stock price falls over 40%. And then, of course, the New York Stock Exchange halts trading. Soon thereafter, Equity Funding of America dissolves. Equity Funding had indeed been full of or rife with fraud. The SEC found that Dirks was a tippee who had violated insider trading laws by passing on inside information to others who then sold securities based on that information. But the Supreme Court, in effect, held that the pure motives of the parties meant that there was no illegal insider trading. That was because, in effect, the Equity Funding employees' disclosures to Dirks were not motivated by personal gain, nor was Dirks communicating this information to other people meant to enrich Dirks. Because Dirks sought to expose fraud, he had no duty to refrain from using the information he had obtained. So the Supreme Court held. So we have against insider trading strong federal laws with strong enforcement given the limited resources available. So it's not the enforcement necessarily, and it's certainly not the laws, it's more the definitions and standards in complex cases that are still sometimes rather vague. The 1984 Insider Trading Sanctions Act and the 88 Insider Trading and Fraud Enforcement Act both increased the jail time, fines, and civil penalties for insider trading violations. And the 88 Act gave the SEC greater rulemaking power to mandate specific procedures intended to prevent insider trading. The SEC also was given authority to award bounty payments, your ears should pick up now, bounty payments, to persons providing information leading to insider trading convictions. Whatever penalties are assessed in an insider trading case, the whistleblower can get a percentage up to 10% of the penalty amount as a reward. There are other statutes on corporate insiders besides 10b. One is Section 16 of the 1934 Act. 16A of that Act requires that corporations regulated under the 1934 Securities Exchange Act, as well as those corporations' officers and directors, and also any shareholders holding more than 10% of the shares, file reports with the SEC concerning their ownership and trading of the corporate shares. 16B provides for automatic recapture by the corporation of insiders' profits when those insider officers, directors, or 10% plus shareholders make a short-term profit by selling or buying the corporate shares within a 6-month short swing time frame is what it's called. The most important 16B case involved the Emerson Electric Company, aptly named, and since I seem to be the one most qualified to speak on behalf of this case, I've got my Emerson hat here to go over the facts. In this instance, Emerson Electric owned 13.2% of Dodge Manufacturing Company stock. Just 2 months, that's well before the 6-month short swing time period had elapsed, just 2 months after acquiring the stock, Emerson sold enough of these 13.2% of the shares to bring the holdings that it held down to 9.96% of the shares. And that was structured in such a way that there really was very little, if any, profits, so they didn't have to pay much in the way of taxes or recapture on that. Then, 2 weeks later, again, this is only a little over 2 months after they first got the stock, and thus well before the 6-month time period, Emerson sells the rest of the stock, and this time at a tremendous profit. Did Emerson have to disgorge the profits on its sale? No. Emerson, first of all, wasn't an insider under Section 16. It wasn't a director or an officer, and it was not a holder of more than 10% of Dodge's stock at the time of the second transaction, when it held 9.96% of the stock. So Section 16 is a rather arbitrary, rather technical statute that draws a stark line between those groups and transactions which are covered, on which a corporation can expect to recapture their stock profits, and those groups or transactions in which there is no such recapture. Of course, Emerson could have avoided the whole problem by simply holding on to the stock for more than 6 months, but instead it found another way to avoid the operation of 16 by simply bringing down the level of stock that it owned to below 10% and then selling that remainder. That way, it was kept from having to, in effect, permit Dodge Manufacturing to recapture the profit that it made off of Dodge Manufacturing stock. So in effect, what you have is Emerson is acting like a taxpayer who takes advantage of all the deductions and credits that he can use to lower his income tax. As long as one doesn't violate the little wording of Section 16, one can structure the amounts and timing of stock purchases and sales so as to keep profits rather than have to give those profits back to the corporation. Emerson did it with some fancy footwork, and that's just fine and good. I want to introduce the players here who on short notice responded, I think, rather gallantly to perform as tippers, tippees, opposite sex, all sorts of things going on up here. Kim Rawlerson, Aiden Ford, and Damon Rowe. We'll talk with them. Thank you very much.